Tesla's stock jumped 3% this week, and thousands of traders who bought call options to catch that move still lost the trade.
And this is exactly where beginners feel cheated, because nobody told them that being right isn't enough.
How is it possible to be right about a call option but still lose money on that option? Because call options only start making money after the stock passes a break-even price, a key figure most beginners fail to calculate.
Miss it by $1 and the market doesn't care how right you were.
Most platforms calculate break-evens for us, but beginners ignore it. The break-even price is the stock price you must reach to recover what you paid to enter the options trade. Call buyers expect to profit when the stock rises. Put buyers expect to profit when the stock falls. For calls, break-even equals strike price plus premium paid. For puts, it is strike price minus premium paid. Tesla trades at $455 right now. You buy a $460 call option for a $3 premium, means your break-even price is $463.
That's not your target, that's your starting line.
Which also means your cost is $300 total for one contract covering 100 shares. Now, whether you're new or familiar with calls, puts, strikes, and premiums, episode 1 breaks these down clearly to build a strong foundation. This episode focuses on the crucial next step, knowing when your option trade begins making money. For puts, a $450 put costing $3 means your break-even price is $447. The stock must fall below this level to start generating profit. An options price splits into two components: intrinsic value, real immediate profit if exercised now.
This is the only part of an option the market can't take away from you.
Extrinsic value, the premium for the time and volatility remaining.
And this is the part that quietly bleeds every single day.
For example, Tesla at 455 and a 450 call has $5 intrinsic value. If the option price is $7, the extra $2 is extrinsic value. That decays over time,
whether you're watching the chart or not.
Extrinsic value erodes daily. This is time decay, or theta. If Tesla's price stays flat, your $7 option might drop to $6.50 in 10 days. You lose 50 cents per share just because time passes, not because the stock moves.
That's the part nobody warns you about.
Theta loss accelerates near expiration. Avoid buying options expiring in less than 30 to 45 days to allow time for your thesis to work. Before any trade, 1. Calculate your exact break-even price. 2. Confirm if the stock can realistically reach that price before expiration. 3. Avoid trades requiring unlikely or extreme price moves. This checklist helps separate consistent traders from gamblers. Now let's dive deeper into each of these concepts so you understand exactly why this matters and how to apply it to every trade. Let me show you why thousands of traders lost money on Tesla this week, even though they were directionally correct. Most beginners think their strike price is their break-even. It's not, and that misconception costs people real money every single day. Let's go back to that Tesla example and break it down step by step. Tesla is trading at $455. You think it's going up, so you buy a $460 call option. The premium is $3 per share. Here's what most beginners think. My strike is $460, so if Tesla hits $460, I make money. Wrong. You pay $3 to enter this trade. That $3 needs to be recovered before you start making profit. So your break even is $460 strike plus $3 premium equals $463. Let's see what happens at different price points. If Tesla hits $460 at expiration, you lose $300. If Tesla hits $462, you lose $100. If Tesla hits $463, you break even. Zero profit, zero loss. If Tesla hits $465, now you're making $2 per share profit. Times 100 shares equals $200 profit. This is why those Tesla traders lost money this week. Tesla jumped from 440 to 455, a 3% move, but their break-evens were at 465, 470, 480. The stock moved in their favor, but not enough to cross their break-even. For calls, break-even equals strike price plus premium. Write this down, it's non-negotiable. Now let's do the exact same thing with puts. You think Tesla is going to drop, so you buy a $450 put. The premium is $3 per share. That's $300 total cost. What's your break even? It's not 450. You subtract the premium from the strike. $450 strike minus $3 premium equals $447. Let's see what happens at different price points. If Tesla drops to 450 at expiration, you lose $300. If Tesla drops to 448, you lose $100. If Tesla drops to 447, you break even. If Tesla drops to 445, now you're making $2 per share profit. Times 100 equals $200. For puts, break even equals strike price minus premium. Addition for calls, subtraction for puts. That's all the math you need. Here's the brutal truth that no one wants to hear. You can be right about the direction and still lose money. You can predict the move correctly, you can time the entry perfectly, you can choose the right expiration and still lose. Why? Because the stock didn't move far enough to cross your break even before time ran out. This is the difference between stock trading and options trading. With stocks, any upward movement equals profit. With options, you need enough upward movement to overcome your premium cost. Before you place any trade, you need to ask yourself, is it realistic for this stock to reach my break even before expiration? If you need a 10% move in 2 weeks, is that realistic? If you need 15% move in 1 week, is that realistic? If the answer is no, don't take the trade. Walk away. Avoid trades requiring unlikely or extreme price moves. This one principle will save you thousands of dollars. Now, let's talk about what you're actually buying when you pay that premium. Every option price is made up of two parts: intrinsic value and extrinsic value, real value and time value. Intrinsic value is the profit that already exists in the option right now. It's the real, spendable, tangible value. Here's how you calculate it. For a call option, intrinsic value equals stock price minus strike price, but only if the stock price is above the strike price. Let's use our Tesla example again. Tesla is at 455. You own a 450 call. 455 minus 450 equals $5. That $5 is intrinsic value. Real profit built in, guaranteed. Now, if that option is trading for $7 total, $5 is intrinsic value, the extra $2 is extrinsic value. Here's the critical rule. Intrinsic value can never be negative. If Tesla is at 450 and your call strike is 460, the stock is below your strike. That means your option has zero intrinsic value. It's out of the money. If your option is trading for $3, all of that is extrinsic value. It's pure hope, pure time, pure potential. No real profit yet. Why does this matter, you ask? Because only intrinsic value is guaranteed. Extrinsic value disappears over time. This is called time decay, or theta. And here's what beginners don't understand. Your option loses value every single day just from time passing, even if the stock doesn't move, even if nothing changes. Time alone eats your premium. Let me show you exactly how devastating this is. You buy an option for $4, $2 is intrinsic value, $2 is extrinsic value. 30 days until expiration, the stock stays completely flat, doesn't move up, doesn't move down. 10 days pass, your option is now worth $3.50. Why? Their intrinsic value is still $2, nothing changed there, but the extrinsic value dropped from $2 to $1.50. You lost 50 cents per share times 100 shares, that's $50 gone. You did nothing wrong, the stock didn't move against you, you simply ran out of time. That's time decay. And it gets worse as you approach expiration. Theta loss accelerates near expiration. In the final week before your option expires, time decay goes into overdrive. Your option can lose 10% today, 15% tomorrow, 20% the next day, just from time passing. This is why buying options with 1 week left is financial suicide for beginners.
You're fighting the clock and the clock never blinks.
You're not buying opportunity, you're buying a melting ice cube. Here's your rule as a beginner. Avoid buying options expiring in less than 30 to 45 days. Give yourself time for your thesis to work. Yes, longer dated options cost more, but you're paying for flexibility. You are paying for breathing room. You are paying for a chance to be right. Time is your ally when you have weeks or months left. Time is your enemy when you have days left. Now there is a way to profit from time decay instead of losing to it. It's called selling options, but that's episode 4. Right now you need to understand how time decay destroys beginners so you don't become another statistic. Let's walk through a complete trade from start to finish. This is how you apply everything we just covered. Apple is trading at $180. Earnings are coming next week, and you've done your research, you think it's going up. You decide to buy a call option. Here's your process before you click buy. Step 1, pick your strike. You want a realistic target, so you pick 185. That's $5 above the current price. Not too far, not too close. Step 2, pick your expiration. Earnings are a week away, but you want buffer time in case the move takes longer. You pick 3 weeks out. Smart move. Step 3, check the premium. The option is trading at $3 per share. Times 100 shares equals $300 total cost. That's your maximum risk. That's the absolute most you can lose. Step 4, calculate your break even. Strike price 185 plus $3 premium equals 188. Now you ask the critical question. Is it realistic for Apple to go from 180 to 188 in 3 weeks? That's a 4.4% move. If you believe yes, based on your research, take the trade. If you believe no, walk away. Let's say you take it. 2 days later, Apple jumps to $184 on strong pre-earnings momentum. You check on your option, it's now worth $4.50. You paid $3, it's now $4.50. You're up $1.50 per share. Times 100 shares equals $150 profit. That's a 50% gain in 2 days.
And this is where discipline matters more than strategy.
On a $300 investment. This is the leverage power of options when you understand the mechanics. But here's where 90% of beginners blow it. They see that 50% gain and think, if I made 50% in 2 days, imagine what I'll make in 2 more days. So they hold, and you know the story. Apple stalls at 184, doesn't move up, doesn't move down. 5 days pass, you check your option, it's now worth $375. What happened? Time decay happened. The stock didn't fall. Your thesis wasn't wrong, but time eroded your extrinsic value
While you waited.
for more profit. You went from up 50% to up 25% because you got greedy.
Not wrong, just impatient.
Here's the rule. If you hit your profit target, take it. Lock it in. Walk away. Don't wait for the perfect exit. 50% gains in 2 days is a massive win. Take it. You can always re-enter if the setup comes back. But you can't recover profits you gave away by holding too long. Before any options trade, run through this 3-point checklist. Number 1, calculate your break-even price. For calls, add the premium to the strike. For puts, subtract the premium from the strike. Number 2, Confirm if the stock can realistically reach that price before expiration. Don't rely on hope. Use research, technicals, catalysts. Number 3, avoid trades requiring unlikely or extreme price moves. If you need a 15% move in 1 week, you're gambling. If you need a 5% move in 3 weeks, you're trading. Know the difference. This checklist helps separate consistent traders from gamblers. This is what professionals do before every single trade. If you can't answer all 3 questions with confidence, don't take the trade. This is what I want you to do. Open Tesla's options chain in your broker. Find the premiums for the $460 call and the $450 put. Calculate the break-even prices for both. Write them down. Get comfortable with the math. This only becomes second nature through repetition. Don't just watch, practice. Understanding break-even math is foundational for profitable option trading. Most beginners skip this and wonder why they keep losing money. You're not going to be one of them. If this clarified break-evens and time decay for you, hit that like button. Subscribe for episode 3, where we'll simplify reading option chains for confident trading. Next episode will unlock the mysteries of option chains and show you exactly what to look for before entering any trade. Comment below with your biggest takeaway from today. See you there. Episode 3 drops next week. Subscribe so you don't miss it.